Hello and welcome everyone to the weekend market analysis video where I try to uncover a lot of market action and a lot of data points and my view going forward. So if you look at the title today, it is Influential Inflection Point. So right now markets are sitting at a very crucial crossroads and a lot of pivotal data is going to come next week. So please stay tuned for the entire video so that we can uncover everything from multiple different perspectives and I can give you my honest, unbiased opinion on the markets. So without further ado, let's jump on to the analysis, fundamentally, technically, and then lastly, macro analysis. So before going on to the market analysis, I wanted to announce some major enhancement into my content creation journey. So I had a lot of research done on all the YouTube, Instagram, and other platforms. And what I found out is the attention span of people wanting to know about financial world is continuously decreasing. So I had a problem like how can I give the most precise information in the most optimal way, thereby reducing the viewer time and giving all the insight as well. So I came up with a solution to create a brand new WhatsApp channel, and that was the intent to save the viewers time and to also give them the rightful information that they need in real time, because the video creation and creation of reels takes a lot of time, but writing a few lines in text is almost a real time. So for the people who don't know and for the people who are interested into getting real-time insights and a lot of financial knowledge in the textual form, you are more than welcome to view my WhatsApp channel, and the link is going to be in the description below, and also it goes through my same name. So let me show you exactly what I mean over here. So if you see, this is my WhatsApp channel and its name is TradesByAdvait. Right now it is not discoverable in public on WhatsApp, but you can go into the link in the description below and you can join directly. The reason why I am promoting this is because you don't need to have 30 minutes a day to spend and see my video. What you can do is you can come over here, join the channel, and as you can see, I post a lot of meaningful insights and a lot of reasonable thinking process and my rationale and my charts almost in the real time. So as you can see over here, you can react with the emojis, and you can react with a lot of expressions, and there are a lot of handles that like investors, traders, and everyone, so that I don't waste your time. If you are an investor, you can ignore the content which is directed to traders. So a lot of very helpful insights are being posted by me, what's going on in my mind, why do I think the way I do. So you can see a lot of work that is going on and which might be really helpful for you. So feel free to join this channel and get the updates, turn on the notification, and again, this is the WhatsApp channel. So coming on and moving forward with the actual market analysis, let us discuss what is happening in the macro environment right now. So the first point that I wanted to discuss is Fed Chair Jerome Powell had his testimony, in last 2 weeks. So the entire narrative is shifted from inflation to the labor market. Now the Fed Chair is, using the phrases like balance of risk. So what does he mean exactly when he says balance of risk? It is basically he's trying to balance the war between the inflation and also controlling the labor market. So remember, Federal Reserve is the central bank of United States, and it has two important mandates, that is controlling inflation and also stabilizing the labor market. So the war on inflation is being fought by raising the interest rates, but at the same time, they also need to make sure that they are not breaking the labor market. So when I say breaking the labor market, what do I mean? I mean that the unemployment rate and the jobs should not decline very rapidly, or should not, raise concerns for the, everyday Americans. So I will discuss about the current status of labor market in the coming sections, but just for an overview, know that now the Fed is putting more emphasis on the labor market situation rather than fighting inflation, because the narrative has shifted from, inflation will not resurge higher, and the risk of losing the labor market is more than the risk of inflation going high. And that is why Fed Chair Jerome Powell is signaling the balance of risks in the testimony. So that's the complete change in the narrative from Fed, and rightfully so, because right now the trajectory, the overall path of the inflation is sustainably coming down, and if we can see certain hiccups, but I'll also discuss those factors in the coming sections. coming on to the recent events with the ex-president of United States, Trump, the assassination attempt failed, and that's a very, good news that, Trump is saved, and, there is no, major, health issues with Trump. So God bless him, and I do not support any kind of violence. So, thank God that, he's not being harmed, and he's still living and healthy. So the financial implications of, Trump's assassination attempt is what I wanted to discuss today. And the thing is, Trump is a Republican, and Republicans are pro-business. Now, when I say pro-business, it means lesser taxes on the business and lesser regulations on the businesses. So if there are, high chances of Trump being re-elected, then it will be really good for the equity markets, because Republicans, as I said, they are pro-business. So since the assassination attempt failed, and I think the odds or the probability of Trump winning this election has considerably increased, that is good news for the equity markets. So these are my these are my thoughts from financials perspective on the Trump assassination. So that's my take on Trump's assassination attempt. The next thing that I wanted to discuss is the next rate cut. So there is a lot of buzz around, Federal Reserve, cutting the interest rates, when it will cut and how much it will cut. So rather than, speculating and rather than assuming, why not, see in a quantifiable manner what's going to happen. And the best tool that I have found is the Fed Watch tool. And let me show you the Fed Watch tool to exactly quantify and talk in terms of numbers when the interest rate cuts are going to happen and by how much. So let me exactly show you the Fed Watch tool, and let me tell you the exact trajectory of interest rates going forward. So this is the Fed Watch tool, that is CME Fed Watch tool, Chicago Mercantile Exchange website. I'm going to post this link in the description below so that you can check out in real time by yourself. So in this website, if you see, these are the dates of the FOMC meeting. That means these are the dates when Federal Reserve will announce its interest rate decision. So the next Fed meeting happens to be in the next week, that is coming week, on 31st of July. And as you can see, there are 95.9% chances that the Fed is going to keep the rates at 525 to 550 basis points. That means the Fed is not going to cut on 31st July Fed meeting. And then when you go to the 18th September, that is exactly after 18 days, July, then August, then September. So after, 1 month, 1.5 months, you can see that Fed has, this Fed Watch tool is signaling a cut of 25 basis points. That is the first cut. So calm down, everybody. Fed is not going to cut on 31st July. So rate cuts are going to happen after 1.5 months. Yes, there is absolutely a technical possibility that, Fed may announce a surprise cut. But, according to the Fed Watch tool, I don't see a rate cut coming at least until September. So by the September, we'll have 2 inflation ratings, and we'll have 2 job market ratings, and we'll have a lot more data to confirm the thesis. So by then, at least for now, there is no rate cut in the horizon until September 18, 2024. So that's what the Fed Watch tool suggests. As you can see over here in November, there is even more rate cuts. So until, September Fed meeting, I don't see any rate cuts. This is according to the Fed Watch tool. And in my experience, it is very accurate. And I have been following this Fed Watch tool since last 2-3 years, and it is very, very accurate. So this is my, take on the exact timeline on when the rate cuts are going to happen and by how much. So when I say 25 basis points, or when I say, 50 basis points, it's basically 0.25 to 0.5%. So what we see in September is only 25 basis points, that is 0.25%. It's not much, but at least it is giving a signal that, hey, the rate cuts have started. And remember, we have elections in November. So, if Trump gets elected, he is definitely going to put a lot of pressure on Fed to cut the rates. So you can, consider those factors as well. So that is basically what I wanted to share in terms of interest rate cuts and where we are. So let's jump on to the next point, that is sector rotation. So you have seen a lot of correction that is happening since last 2 weeks, and especially it is almost 10% correction. So right now we are in a correction territory from the all-time high to the absolute low in the last week. So why is this happening? So what is happening right now is, if you see, the Nasdaq index is corrected almost 10%. S&P has corrected a little bit less. But on the contrary, the IWM, that is the small caps or the Russell 2000 index, has gone up. So what is happening is the money or the capital flow is coming out of big tech, especially from the AI names, to the small cap. Why? Because this is happening in the anticipation of the lower rates, because when the rates are lower, the small cap companies will be the direct beneficiary of these lower rate environments. So that is why they are being revived, and they are seeing a massive rally. So that is why that explains the divergence between the S&P 500 and Nasdaq index going down and the Russell 2000 going up. So that is the sector rotation for you guys. Now a lot of people are speculating and assuming that now we are going to have a big recession and we are going to have a huge downfall. So I'll tell you my take on it. Right now, as of the time of this recording of this video, I do not see a systemic risk in sight yet. I do not see a high level of delinquencies. I do not see a high level of debt in the financial system, which is not unsustainable. So right now, I don't see a systemic risk in the economy. It may turn out to be dirty and it may turn out very bad, but so far everything is in control. So far, I don't see there was tech bubble in 2000s. There was real estate bubble in 2008. But right now, what we are seeing is the earnings are holding up fairly well. And as long as the earnings are holding up fairly well, as long as people have jobs, I don't see a systemic risk, or I don't see a lot of 30-40% downfall, which other people are recommending. So that's my take on the economy on a 10,000-foot overview front. Now, the most important thing that I wanted to discuss is, at this time of the year, between July to September, there is always a short correction in the markets. So a 5 to 10% or a 10 to 12% correction in the markets is very, very healthy. It is like these dips have always historically been bought up. So this sideways actions until election 5% 10% correction is going to be an extremely good buying opportunities if you look at the long term. So I don't see this 10% correction as a start of something really bad. As long as this correction is contained in less than 12%, it should be very, very healthy, and it should be okay, and it should recover very, very fast. So that's my take on the overall macroeconomic events on, as of the time of this recording. These are the points that I wanted to discuss in terms of macro, because it is very important for an investor to know where the bigger headwinds are. So these are the bigger headwinds that we discussed. If something changes, I'll let you know. But right now, this is my take on the overall, American economy. Let us start analyzing the weekly time frame charts to get a good grasp of what is happening. So in the weekly time frame analysis, I wanted to highlight two important things, that is support and resistance levels. And I wanted to highlight one key specific things of why we use, Fibonacci levels. So let us go into the charts and discover. So as you can see over here, this is a weekly chart. And in this weekly chart, for the people who are new, I have plotted the Fibonacci pattern from the top of the 2021 highs and the lows of the 2022. And this Fibonacci pattern, as you can see over here in color coded one, it has perfectly rejected from the 1.618 level. So this is exactly why I have drawn this major correction or major bear market that happened in 2022. And I wanted to know at what level there are very high chances of the markets to pull back. So as you can see over here, this ratio 1.618 is the ratio where the Fibonacci pattern was screamingly telling us that okay, it is a time for rest or it is a time for pullback. And look at what happened. It exactly pulled back from this level. So these as and when you increase the time horizons, the technicals works even more better and even with more accuracy. So the higher the time frame, the better probability you get in terms of technical analysis. So I wanted to point out this, and also it happened exactly the same on the 0.618 level as well. So if you look in the past, when we broke above the 0.618 level, we actually visited it again, forming a really good base over here and then going higher. So this 0.618 and 1.618 levels, these are the Fibonacci levels which are extremely important. So keep a close eye on this. And as you can see, we have perfectly rejected from this level. And now let us discuss the support and resistance level. So the support in the extreme near term is the median median line of the Bollinger Band, that is the yellow line that you see over here. And we have exactly taken the support from here since last week. And the medium term support is this red line, that is 26-day EMA. And why am I telling this? Because if you look at the past, the 26-day EMA, that is the red line over here, has acted as a very good support, over here, and then if you go over here, once over here. So like there is a lot of times when the weekly time frame 26-day EMA acts as a good support. So that's regarding the support. Now let's talk about the resistance. So the first resistance is the 20,000 level, that is the psychological resistance, and ultimately the 1.618 level, that is this one, 20,640, is going to be the ultimate resistance. There is 100% chance that we are going to break this level in the future, but we have to be really mindful, because we might, since this is a weekly time frame, we might not do, this year, or by the end of this year we might do. So there is a lot of, expected chop that is going to happen in this area, since we are approaching elections and since we are approaching the start of the rate cut cycle. So in the weekly time frame, the only two levels that you need to actually make a note of is this level, that is 0.618 level, and this level, that is 26-day EMA, that is the red line over here that you see. Now one more important level is this white line, that is the year to date anchored VWAP. So let's say if we go down, and if we go down more than this 26-day EMA, then the immediate area of support on the anchored VWAP level, that is this white line, is over here. So I personally don't think that we're gonna visit this in a straight line, but hey, if we go into a recession, then there are very high chance. So this is my take on the weekly time frame. I discussed the resistance levels, I discussed the support levels, so kindly make a note of that and expect a good amount of chop in this area as far as weekly time frame is concerned. Now let's draw our attention from weekly time frame to daily time frame. In the daily time frame, there are 2 to 3 very important things that I want to discuss and that I want to show. Now, the first one is the bearish crossover that happened with the short-term moving average crossing the long-term moving average from above. So let me show you exactly what do I mean over here. So as you can see, this is the daily chart. And for the short-term moving average, I use the blue line over here, that is 5-day exponential moving average. And for the long-term moving average, what I use is the red line, that is 26-day moving average. Now, as you can see over here, last week, we got a bearish crossover in the moving averages. So in technical analysis, whenever you get a bearish crossover, that is crossing of short-term moving average to the long-term moving average from the upside, that is a very, bearish signal. So technically, the EMAs are suggesting a bearish theme of the markets. And the second important point on the daily time frame is we have closed below the 50-day moving average, that is the green line that you see over here, that is this one, that is orange kind of thing. So this are these two developments technically, that is the crossover of the EMA and the closing below the 50-day moving average, is a very bearish sign. Now that is in terms of technicals, that is the exponential moving average and the 50-day moving average, which is a very important barometer in terms of technical analysis. Now the good news is we are holding above the S1 support, that is the pivot level over here. So we haven't touched it yet. So what I think is, like, if you can see over here, if I draw a measuring chart from here to here, that is the all-time high to the absolute bottom since the last week, the important point is we were down more than 10%, that is 10.05%, so almost in a correction territory. So whenever this correction territory happens, whenever the market pulls back more than 10% or 8 to 10%, it is an extremely healthy sign of the market. It is chopping out all the fat and all the excess liquidity, and this is a very important point where early investors, or where the people who wants to start investing in the markets, can get in. So this is exactly when we were 10% down or when we were 8% down, this is exactly why I announced on my channel, that is WhatsApp channel, and the link is in the description below. And you can see that I have told people to deploy 25% of their capital at this point. Why? Because these kind of pullbacks, that is 8 to 10% corrections, are extremely healthy and it's an extremely good buying sign. Now that was regarding how much we are down. Now other point that I wanted to make is, since we are 10% 10% down, there are very high chances that we are forming a bottom. So whenever we form a bottom, usually what happens is, usually there is some kind of W formation happens. So if we go over here, if we see the bottom formation of the geopolitical tensions, you can see over here April 19th, when the lot of geopolitical tensions were happening between Israel and Hamas. This is where you can see, if I can draw a marker, like market moves down, it goes up, fetches excess liquidity, and then goes down, and then again goes up. So this is how the bottoms are formed. And when I say W pattern, this is exactly what I'm talking about. So what I expect over here, if this is a bottom, then there has to be some kind of W pattern forming. So over here you can see this. Now expect something like this, that is a dead cat bounce, and then something like this, and then this. So what can cause this kind of pattern? So in this week, that is coming week, we have a lot of important events like FOMC meeting, that is Fed chairman's remarks as well. We have a lot of main 4 of the Mag 7 companies, that is Apple, Amazon, Meta, and Microsoft. All of them are going to announce the earnings next week. So whatever may be the fundamental catalyst, there will be a good deep. Only then, if we recover, then this will be a formation of W pattern and a formation of base. So what I suggested to all the viewers personally on the WhatsApp channel as well, that deploy 25% of the capital over here for a long side, and then wait for the W pattern once it forms, and then you can have a confirmation that okay, this was the bottom, and then we can go higher. So this was regarding the daily time frame. Now let me discuss the areas of support. So let us say for the next week, if one of the or two of the Mag 4 companies come out with the bad earnings, then there is a very high chance that we test this S1 pivot level. Now if we test this S1 pivot level, then it would be an extremely good buying opportunity. Technically, this S1 level on a daily time frame will result in almost 12% pullback. So historically, if you see, that was a very good buying opportunity. So that is regarding the support levels on the daily time frame. Let me discuss the resistance levels. So since we are down from the 50-day EMA, the first thing that bulls needs to reclaim is the 5-day moving average, that is the blue line, the 50-day moving average, that is the orange line, and the 26-day EMA, that is the red line. So we need to cross above these levels to go higher, because these are the zones of supply. These are the zones where a lot of selling will happen, and once we eliminate all those selling, only then the markets can go up. So those are the resistance zones that investors and traders need to be mindful of. And then once we form the W pattern, then I can expect markets to rally higher. So that is my take on the daily time frame. As you can see, this inside day, that is Friday's session, had a reasonably good volume. The selling has been happening with high amounts of volume. So ideally what happens is, whenever we form a bottom, there is essentially an increase in the volume, and that is what suggests that the trend in the markets are about to shift. So all the technicals are suggesting that we are due for a good bounce back. So that is my take and conclusion from the daily time frame. Coming on to my favorite section of this video, that is anchored VWAPs. So I wanted to share, few updates regarding the anchored VWAP charts and where we are in terms of markets in correlation to the anchored VWAP charts. So without further ado, let's go into the charts. So here is the anchored VWAP charts, and this is the daily time frame. And as you can see over here, when we started the downfall, that is on the Nasdaq markets over here, we are right now just consolidating near the geopolitical tensions anchor. So what I did was, when we formed a bottom on April 19th, I plotted an anchored VWAP, that is the white line over here, and I also plotted a yellow line, that is a change in the momentum of the price over here. So why am I saying this? It is because if the market reverses from here, it is very essential for the markets to hold the geopolitical tensions anchor, which is designated over here by white line. Now, as long as we are above this white line, that is signifying the geopolitical tensions anchored VWAP, we should be good. So the crux of this anchored VWAP chart is, keep a close eye on this level, that is the white line, and see if we are not closing on a daily basis below this level. Even if we do, if we reclaim it in, let's say, 2 to 3 days, then it will be considered as extremely bullish sign. So as long as the market is above this geopolitical tensions, anchored VWAP line, the bias should be bullish. So this is one thing. The second and the most important anchored VWAP that I wanted to discuss is the red line over here, that is year to date anchored VWAP. So where is this coming from? Basically, when we started this year around January 2 for the trading session, I plotted this red line over here as the anchored VWAP. Now this red line is this one. Let us say that markets decide to go down south, then the ultimate area of support is going to be this one, that is the red line over here, year to date anchored VWAP. Now remember, this is very unlikely, but if market decides to go south, then this would be a very key area of interest of support over here. So remember these two lines, the white line and the red line over here, and you can see the exact levels, that is 19,140, and over here that is 18,428 levels. So these two levels are of extreme importance, and if market holds these levels, then that will be considered extremely bullish. So these two anchor points I wanted to discuss in this daily chart of anchored VWAP sessions. As you can see, there are a lot of anchors above this level, but those will act as a resistance zones once the markets tries to reclaim those. So I will update these anchor points and these anchored VWAP, and I will also share the screenshot in the WhatsApp channel. So make sure that you join to get the latest update and where am I plotting these anchored VWAPs and why am I plotting. So over here the naming conventions should be very clear as to explain why am I plotting at that certain point. So that's all I wanted to share from the anchored VWAP standpoint. So just keep a close eye on this anchor and this anchor. So now let us go to the next section of the video. In this section of the video, I wanted to address and discuss some miscellaneous topics that are hot today and people are concerned about. So let us start with the first point, wherein the AI sector, that is the AI stocks, have corrected too much. So if you look at Nvidia, if you look at AMD, if you look at the AI names like Snowflake, or if you look at Supermicro, they have corrected heavily in this correction. They are down 20, 30, in some cases 40%. So is this a good thing? Now, first thing is, it is really good thing that the valuations have come down. So the correction in the AI stocks is good, because it doesn't let the markets to go into the bubble territory. So am I interested in these levels right now? Absolutely not. So if you look at individual stocks, a lot of them are going to report earnings. So if you look at Nvidia, it is going to report earnings in August, maybe. If you look at Supermicro, it is going to report the earnings in August. So there is a lot of earnings that are anticipated in terms of AI. So right now I am in a no man's land, wherein I am staying outside. I'm just observing and watching if these AI stocks can continue the earnings, the stellar quarters sustainably. Only then there is a scope of recovery. But if they don't, and if they do not surpass the expectations, then more correction will happen. So right now, a smart investor or an informed individual would stay on the sidelines and see how the earnings call is going to go and what is going to be the trajectory of the AI industry. So I am not interested into investing at these levels even after such a massive correction. I would want to have good data points that can prove that these earnings are sustainable. So that's what I'm looking for. Coming on to the second point, the people who are saying that there is going to be a huge correction and huge bear market, remember that there is $6.4 trillion with a T sitting in the money markets fund right now. So with that amount of buying power, there is very less probability that the markets will correct 30 to 40%. So let me show you what do I mean over here. So this is the chart of money market fund, that is total financial assets level given by the Federal Reserve. So you can see over here the money markets funds amount is constantly increasing. So 6.4 trillion, it was 6.3 trillion, then in the July it was around 6.1 trillion. So when you have so much buying power outside of the equity markets, a small correction or a major dip is going to get bought, because this cash is only lucrative over here as long as Fed keeps the interest rates this high. But what do we know? We know that the rate cuts are on the horizon, and the rate cuts are going to happen in September. So when these rate cuts happen in September, the fundamental reason of keeping money in the money markets fund is gone. because now you're not earning a lucrative interest on this money. So when you don't get a lucrative interest on the money, where does it go? It goes to the higher riskier assets, namely stock markets. So these kind of corrections will be bought because we have a huge buying power over here, because the capital is going to flow from here to equity markets. So this is a good data point that I wanted to share, that right now, as of the time of this recording, 6.4 trillion is sitting in the money markets fund, which can anytime, even if 5% of this thing goes out and comes to the equity markets, then we will see a huge rally. So this is the power of fund flows, and you have to that the positioning and the capital flows, how it goes from one asset class to another asset class, so that you can determine what is going to be the trajectory of the markets going forward. So going on to the next point, I already discussed that September is going to be the most likely day where the Fed is going to give the first rate cut, because I discussed the Fed Watch tool earlier in this video, so you can refer to that section. Regarding the role of elections, normally what happens is till the election, that is till November, so July till November, the markets tend to be choppy, tend to have dips or something like that. And then once the election happens, and once the president is elected, once the stability returns, then we see a very nice Christmas rally. So right now we are in the midst of the chaos, and right now we are already down by 10%. So we have already got that September dip, so early, that means in July itself. So this is my take on the trajectory of markets moving forward. So moving on to the next point, you can see that last month crude corrected heavily. So crude oil went from $82, $84 to now right now it is stabilizing at $78. So this is a very welcoming sign, where crude oil is coming down, and because crude oil is coming down, there will be a downward pressure on inflation. So if there is a downward pressure on inflation numbers, then this gives an incentive for the Fed to cut the rates. Now, one important point that I wanted to discuss in terms of crude oil, and how important this commodity is to gain an understanding of how the world economy is doing. So all of you should know that OPEC, that is Organization of Petroleum and Energy Producing Countries, OPEC has since last 2 years announced the voluntary cuts, that is production cuts. Now, even after having so many production cuts, even after Saudi Arabia announced these high production cuts, if the price of crude oil, ideally in these times of scenario where production cuts are happening, should go up, but as opposed to that, it is going down, that is $78, right? So this is telling you that the economy is slowing, and the demand for liquid gold, that is crude oil, is slowing. Because ideally, when Saudi Arabia announces production cuts, it should go up, but the very fact that demand is not exceeding the supply tells you that the economy is mean reversing. So a mean reversion is happening, and economy is stabilizing, and we are coming out of the COVID era. So right now this is a clear-cut indication that the economy is slowing, or I would say, in my terms, the mean reversion is happening on a very grand scale. So this was one of the rationale why crude oil prices are coming down, and why it is a bad news for the world economy. So this is exactly why I keep a close eye on the interrelated asset classes and its prices, so that we can form a very good opinion of how the world is doing. So that's my take on the miscellaneous topics that I wanted to discuss. Let's go and move towards the employment situation right now. So in the start of the video, I already told you that the narrative has been shifted from inflation to the labor market. And today I have a very interesting few data points that I wanted to show you in real time, so that you can get a fair idea of how the employment situation is in the United States. I was digging deeper into the employment data that the government, that is US Bureau of Labor Statistics, that is the governmental body which releases a lot of employment data related to the Americans. So I was researching, and I was trying to make a sense of numbers, and here's what I found. So I wanted to discuss 2 to 3 things. One is the non-farm payrolls, the average weekly hours, and the employed usually working full time. So as you can see, let's go to the charts, and I can show you over here. So this is the all employees, which are total non-farm payrolls being generated, and this is from the Bureau of Labor Statistics. So as you can see over here, the non-farm payrolls have been constantly increasing. So it is pretty evident from the graph that 150, as of the time of this recording, 158 million, payrolls are being generated outside the, farming related, industry. So these are the actual, high paying or economic, jobs which are not related to farming. Now, if you can see over here, this is the average hourly, average hours worked by the employees. And you can see a clear divergence over here. On one hand, the non-farm payrolls are increasing, and on the other hand, the average hours worked by the everyday Americans is decreasing. So what does that mean? The payroll numbers are going up, but the full-time workers the people those should work 40 hours a week or 36 hours a week, that is going down. So what is the conclusion over here? The conclusion over here is the full-time jobs are decreasing, and those full-time jobs which are good jobs, which pays well, which gives you more hours, if those are decreasing, then the labor market quality is deteriorating. So over here you can see that the usually employed people who are working full-time, that graph is going down. And it peaked in 2023. It also peaked in 2023 November, but since then it is going down, and right now also it is going down. So the conclusion that we can take from these three data is the quality jobs, the high paying jobs, because of you may call it tech layoffs, or you may give the whatever name you want to give, that is clearly decreasing. So the quality of high paying jobs is going down, and that is evident from these kind of data. So if non-farm payrolls are coming up, that means the economy is adding more jobs. That is true, but those added jobs are low paying jobs. Those added jobs may be in the services sector, or maybe in freelancing sector, whatever the case may be, but those are not full-time jobs. Because if they are full-time jobs, then why the number of hours worked is constantly decreasing, and why this data, that is the usually full-time employed individuals, is decreasing. So you can now also, I want to share this number, that is the unemployment rate, that is the civilian unemployment rate, which we get every month from the Bureau of Labor Statistics. This is astonishing. So this is going up steadily. So the unemployment rate was at their minimum in January of 2023, and then since then it has steadily been rising. So on one hand, you have an economy in which the quality jobs or the high paying jobs are decreasing, that is the quality of labor market is going down. On the second hand, you are seeing that the unemployment numbers, that is right now the unemployment is sitting at 4.1%, and it is gradually going down. So clearly gradually going up. So clearly the labor markets is seeing cracks, and the labor market is softening down. So now I don't know how much it should soften for the Fed to say, hey, we need to stop this, or we need to backstop this. So that is upon Fed to decide. But clearly from these numbers you can see the same, the amount of unemployment level, or the jobless claims you can see, or unemployment levels, it is steadily increasing. So 6.8 million people are unemployed. So that number is astonishingly rising steadily. So as you can see, like from this entire discussion and from this entire 5 data points over here, the labor market is clearly softening. But is it softening too much? That is the $1,000,000 question to ask, because since the Fed is now focusing more on labor market, and in their language now they are focusing on balance of risk. So till what point they they are ready to endure pain, that is going to be yet to be determined. So we'll have to keep a close watch on the remarks of the Federal Reserve Chairman Jerome Powell, as to get a good idea like how much percentage of unemployment is he willing to see before he starts cutting aggressively. So that's my take on the employment situation in United States. You can see right now it is at 4.1% unemployment, and you can see that non-farm payrolls are constantly increasing. So that's an encouraging sign for economy. But as you can see from here, that the quality jobs are decreasing. So that is not good, and I would not be concerned too much right now, because right now everything seems to be in control. But more or further deterioration from these levels would definitely be an area of concern as an investor or as someone who keeps a close eye on the economy. So that's my take on the unemployment and the labor market situation in United States with these numbers. Coming on to the economic calendar and the impactful events that can affect markets in a meaningful way, this section I want to discuss three important things. First is a lot of Fed speakers are going to speak, this week, and the main, event is going to be the FOMC meeting and the FOMC interest rate decision that is going to come out on Wednesday. So Fed Chair Jerome Powell is going to speak, and they are going to determine like what is going to be the interest rates. Mostly they are going to, hold the rates as it is until September. So that is one of the key economic events that's going to happen on this week, that is Wednesday. Coming on to the earnings, 4 of the Magnificent 7 companies are going to report this week. So starting with, Apple and Amazon on Thursday, Microsoft and Meta on Tuesday and Wednesday respectively. So there is a lot of, anticipation of these big 4 companies, which are of Mag 7, and all the eyes will be looking for the, difference that the earnings can make because of AI. So people are waiting to see if AI is gaining that productivity gains to increase the top line and bottom line. So the impact of AI on top line and bottom line would be very, very worthy to watch this week. And lastly, but not, last but not the least, on Friday, since this is the first Friday of every month, the non-farm payrolls data is going to get released. So the non-farm payroll data gives us a good sense of understanding about the labor market as to what is happening and how many jobs US economy is creating as a whole. So a jam-packed, eventful week is ahead of us. And as I said, fundamentally, earnings and the remarks from the Fed Chair Jerome Powell and a lot of incoming data like non-farm payrolls data is going to shape the future trajectory of the markets. So all in all, if I try to summarize the entire video, I would definitely say that keep a close eye on the big tech earnings, and from the technical analysis standpoint, watch if the W formation is happening or not. I have already shown you in the daily technical analysis section of this video about the W formation. If that happens, then that would mark the bottom of this short-term downtrend. So keep a close eye on all these things, and all in all, I don't see a systemic risk as well. So yeah, that's my understanding, and that's my insights from all the fundamental standpoint, technical standpoint, and macro standpoint. So with this, I would like to thank you for watching, and thanks for taking time. And if you would be so kind to appreciate and leave a like, please share to someone who would benefit. There's a lot of effort that goes into creating such a good educational content. So I would really appreciate if you can like, share, and subscribe this video. Also, do not forget to join the WhatsApp channel, because I post a lot of live time updates regarding the financial markets and my understanding. So you are more than welcome to join that channel as well. So with that in mind, I would like to end this video over here. Thanks for watching. Keep learning, keep growing, and keep trading.